It's a okay day, but metals are holding on. Yes, metals are holding on. Real estate is holding on. Ashok Tyagi joins us. Let's take the conversation forward. Mr. Tyagi, good morning. Thank you for joining us. Our historical conversations have all started about what is happening to the residential market. But today, for a change, I want to understand what is happening in the commercial market, because the world is still divided on what is happening to work from home. It's a yes and it's a no. So what is your sense and what is happening in the commercial real estate market? Because for DLF, the rental commercial space is a very important component now.
Sorry, can you hear me now? Yeah. Sorry. Okay. So, good morning, Nikunj. You are right that normally we always have the residential interview first and the commercial second. This time you have flipped it, so that's fine. Commercial piece, there are two segments to the commercial leasing business, the retail malls and the offices. The retail malls honestly have been like in a stop-start mode since the lockdown began last April. They were shut down for almost 4-5 months. Then from last August, they began recovering. In fact, they had, I think, an excellent recovery in the Diwali, New Year, Christmas season. Then again, the second wave hit us. So again, the malls were shut down. And then again, now they have begun recovering. The footfalls are definitely strong now. The luxury piece is doing even better. But the malls continue to suffer, I'd say, primarily because of the lack of cinemas footfall. And those cinemas, at least in the north, have now begun operating at a 50% capacity utilization. The fact is there's yet no big software of the cinemas so far. So I think once the software starts releasing, and I think that's when the malls will actually get full traction. Now, the offices leasing has been a more a story with sort of more divergent trends. One is obvious that with the entire thing of be it work from home, or the general people sort of re-optimizing their own efficiencies at work. We, and I am sure you have seen in the case of the other listed REITs as well, everyone's seen their vacancy levels go up. So our vacancy levels, which are historically in the 4 to 5% range, are now in the mid-teens. Good news is the last 4-5 months, I think they've begun plateauing out. But maybe it's still at least a couple of more quarters before we can, sort of fully begin concluding the lasting impact of this entire pandemic on the offices leasing business. The good news on the contrary side is that a large number of our regular clients are still there. Cyber Park, which was leased just before the pandemic, no major client except one walked away. The two downtowns that we are building out in Chennai and Gurgaon, again, the pre-leasing traction continues to be strong. A British bank actually, in the midst of the pandemic, signed their biggest global deal for about 700,000 square feet in Chennai with us. So the collections have been extremely robust all through. So the collections have been in the mid-90s to late 90% all through. And I'm sure you must have seen the bigger listed REITs are also reporting similar numbers. But things like automatic escalation of rentals every year, which was a part of a contractual clause, is obviously not happening at that smoother pace. I think clearly the more, the clients who I guess, are getting squeezed more are negotiating with us for rental rebates or at least a deferment of escalations at times. In some cases also optimizing their space. The mark-to-market, which used to be a regular piece in this business, is not working at the pace that it used to work. Having said that, if you look at the US, which actually where a lot of financial services companies are now actually mandating their employees to go back to work, while obviously on the West Coast, the IT companies are still operating from home. So there's a degree of dichotomy. But we believe that fundamentally the Indian premise is strong. This will obviously slow down the pace in the medium term. But I think across the next few quarters, we are hoping that things will come back to normal. The normal may be different than the normal that was there earlier pre-pandemic. But I think the work from home will stay, but it will stay as a component of the entire mix, not as a substitute to the entire office experience. That's like my longish 2-bit, but that's it.
It sets the tone for the interview. So a very basic question is, let's say at beginning of April and 2021, when the second wave was not come, I'm sure you must have done your assumptions in terms of the total rental asset which you would be able to lease and what kind of cash flow projections you had for FY22. Considering that what you've just shared, I'm assuming that your entire commercial space is not occupied and you will have to revisit your cash flows. If yes, what is that number and by how much you will have to now hunker down your cash flow projections?
So, our offices rentals on a run rate basis will be north of 3,000 crores. So a 10% accretion in vacancy levels, arithmetically translates to a 300 crores. But what happens, Nikunj, is that in the year when the vacancy levels arise, the impact is lower because, people serve their notice periods and that sort of thing. So I think the impact maybe this year could be about 300 odd crores there, and maybe another couple of hundred crores on the retail malls business, because that's where, the first 2 months were shut down and now they've begun coming back. But as I mentioned, that the F&B and the cinemas would still take longer to come back. So I'd say maybe the Cybercity portfolio could be missing its pre-pandemic cash flow targets by about 500 odd crores. I think will be a broad number that I think is what we'd also sort of shared in the analyst presentations and all. In fact, we used to have a chart pre-pandemic in the analyst presentations showing our rentals to grow to 4,700 crores by March 22. We believe that target is now deferred by between 12 to 18 months period, depending on how the how the recovery takes place, and God forbid that the third wave, if and when it comes, is not as severe as the second wave was.
You've started launching projects, and what I understand when I speak to some common friends and people who track the real estate market is that Galleria 2 has been launched. That is indication of confidence, right? If that is true, so then are you likely to get in and surprise from the launch of commercial residential real estate and the pricing power which is now coming back for builders?
So, okay, Nikunj. So I guess, my marginal correction. I mean, so far there's been no launch of a project called Galleria 2, but obviously, the market makes its own speculations. We have launched a series of projects in the residential side since October. Primarily in one product segment, which we loosely call independent floors, which is that we pick up our existing plot inventory of plots of 350 square yards to 500 square yards and build a stilt parking and 4 floors. So these are very easy to construct, easy to sell products. What we have realized is that post the pandemic, the number of people who are looking at this as an option versus a classical condo option is actually extremely encouraging. I mean, we launched this project at about 11,000 rupees a square foot price point in October of 2020. And you'd be glad to know that the last edition that we sold, I think in July, was priced at about 15,000 rupees a square foot. And the traction pace continues to be strong. So that is clearly one piece that's doing well. We are in the process of getting the final sets of approvals, etc., before we launch our joint venture housing project in central Delhi, which is the joint venture with GIC, And we have a launch pipeline now figured out across both residential and some commercial parcels, which hopefully in the next 18 odd months, you'd see them come out regularly. Every quarter, you'll see a couple of new launches coming in, sir.
In terms of a trend, would you say that finally after a long hiatus of almost a decade, pricing power is coming back within the realty segment? And are we beginning to at least see early signs of real estate price revival or not?
So, I guess before the price revival, we are definitely seeing signs of a demand revival. There's no doubt about that. In the October-December quarter, people were still sort of, putting it away as a pent-up demand, but I mean, it's sustained now for almost 9 to 10 months, despite that 6-week break during the second wave. So clearly, there's a demand revival. The demand revival also, contrary to what some pundits were saying, is across the price segment. So it's there from the affordable, which is the 30-40 lakh bracket, right up to the camellias, which is the 25 crore bracket. I mean, the camellias are today selling at a pace that we had not sold them for a long time, frankly. So clearly, people in different price points are sort of shedding their inhibitions about buying real estate. The cheap home loans obviously is a big player in this entire thing. As far as pricing is concerned, so from a secondary market, clearly prices have begun strengthening. There's no doubt about that. And even the primary market, I think prices have clearly begun strengthening. But there's a difference. One is that this part of this phase of the residential sector demand revival, if you will, is primarily, I'd say, biased in favor of the bigger, the more credible developers. So it's not like it used to be in the late 2000s or the early 2010s that anybody can pick up a 10-acre plot of land and launch this project and it'll get sold, overnight. That's not going to happen. But if you have a credible brand, a credible delivery record, and a good location, I think clearly the demand has come back. There's no doubt about that. And this you can see from the pre-sales numbers, not only of us, but of other developers in the West, in the South, etc. as well, frankly. Obviously, the pricing will begin, strengthening. Also, I mean, let's face it, the raw material costs have sort of had a runaway inflation in the last 12 months, steel, cement, everything, labor, everything. So clearly, there will be some offsetting of that as well. But I do believe that the industry generally will be well advised to not get into pricing positions based on overconfidence, which could again sort of, lead to a slowing down of the demand recovery. So people need to be responsible about pricing. Obviously, as a credible brand, you can command a premium, but then you have to decide what is the premium that you command. What's actually, doing just a wild pricing, So I think as long as people stay responsible about their pricing positions, you're right. Pricing is beginning to come back, riding on demand coming back.
Interesting. The other thing that I wanted to understand is, I know traditionally you've been largely a real estate player and then into traditional commercial real estate as well. But what one is seeing now is this nascent trend of some of the real estate players getting into data centers, warehousing. At any point in time, would DLF be mulling such sort of a diversification?
We did sign a big data center deal with a very big Singapore operator, and we are building the data center in Noida. That's the first of the data centers that we are building. And obviously, we have geographies where the economics of the location supports data centers. This Noida is the first project that we are doing in that phase. And obviously, but again, we are in the data center, or we want to be in the data center business, like in the ITES business, as a real estate solution provider, not in data center operations. That is not our cup of tea. I mean, there are specialized players who do that, and that's what we should be. But as a real estate solution provider for the data center business, we are doing our first project, which is a big project in Noida, and hopefully, if that comes out well, there should be more to come.
Mr. Tyagi, so what stops you from going into, again, an extension of this, which is the warehousing business? I mean, there are builders who are moving into it. I'm just going to extend Aisha's question slightly forward. This is like a fixed annuity business. You've got land, you've got understanding. Why is that you're not in that business?
So, okay, I mean, I think it's a complex answer. One is clearly that I think we haven't studied the warehousing business in any great degree of detail. So that's the honest answer. B, I don't think whatever little we have studied, we so far aren't convinced with the commercial viability of the profitability of that. And C, again, I mean, I guess, Nikunj, it's a question of bandwidth allocation, that would you rather spend that bandwidth on building out and leasing the downtown in Chennai, or building a warehouse in Gajraula, as an example, in that sense, which is a major North Indian transportation hub. So I think it's a question of, where do you want to allocate your bandwidth? And data centers, actually, we began the first one with some degree of caution, but I think clearly the experience has been very encouraging. So who knows about the future? But so far, yes, warehousing has not been on our radar. Even though there are some locations of ours which would tend to lend themselves for potential warehousing solutions.
Are you now seriously considering expanding and taking slightly more big bets in terms of acquiring new land banks, going to new geographies? Why I'm asking you this is because last couple of years you've brilliantly cut your debt down and you very carefully decided where to expand and where to add capacity. Are you feeling that optimistic at a group level that now it's time to take risk, perhaps what we saw, let's say, in 2004 and 5?
So actually, the second part of the question has made the answer simpler. No, clearly we have no intention of repeating 2004 or 5, that's for sure. Having said that, there are some geographies where we are not present. So as an example, if you look at commercial leasing, we are not present in the biggest geography, which is Bangalore. We are not present in Mumbai. So potentially, if there were, good financially viable opportunities, we could be open to looking at those. What we clearly do not want to do, Nikunj, is build volumes that, buy something at a 8% cap rate and then hope to make spectacular profits on that, because there won't be any significant profits left after you acquire an asset at a 8% or a 7.5% cap rate. But if there are interesting, brownfields, etc., that are available, we would clearly be looking at that. On the residential side, it's again the same piece. So obviously in NCR, in Gurgaon and Delhi, I think we have adequate land banks, and we now have a pretty credible build-out pipeline to those as well. There are geographies like Noida where we are not present, and so if an interesting opportunity comes up in a geography like that, we'd be interested in pursuing it. As far as the other locations are concerned, what we have taken the decision is that we had land banks from the late 2000s in many of the geographies outside. And so far, we were looking at monetizing them by selling them. We have decided that now that given the upswing in the market, we would not be open really to selling those land parcels. We would be open to developing those. So in the next 12 to 18 months period, you will definitely see developments coming up in Goa and in Chennai, 2 geographies for sure. You'll see residential developments come up, and then let's see about others. As you know, Nikunj, we have a joint venture project in Mumbai, but again, it's a 3-partnered project where we are a minority stakeholder of 3/8, 37.5%. So, one needs to work with the other 2 partners to see what the eventual resolution and the solution of bringing that to the market would be. But again, in Mumbai, if there's something very interesting that comes up, in partnership with a local developer, who knows? But we are very conscious of the fact that with a great degree of sacrifice and self-control, we have brought the debt down. We don't want to go back into a re-leveraging spree for sure.
All right, Mr. Tyagi, really appreciate your time. So glad you could join us.
Thanks.